Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Richard Bullis, lead manager of the Martin Currie UK Mid-Cap Fund that features on our wealth shortlist of funds selected for their performance potential. So Richard, the fund can invest in medium-sized companies listed in the UK that feature in the FTSE 250 index, and those are companies you've described as being in the sweet spot between growth potential and maturity. So why is that the case?
You're right, Joe. If you look at the FTSE 250 index in the UK, if you strip out the investment trusts, you've got about 170 companies there. We think some of the best of British companies reside in that mid-cap index. At the bottom end, market cap-wise, about 700 million, up to about 4 billion at the top end. So you're getting the best of both worlds. Some companies that are sort of larger, more mature in size and scale, equally some that are growing quite fast as well, still up the maturity curve. So really getting the best of both worlds, really, i.e. the larger companies have a certain amount of scale and diversification, history, a long-term sort of track record, a certain board structure, corporate governance, big grown-up small caps, for want of a better word. But also they're still small enough where they're still growing. They're still on the growth curve, for example, and that's the exciting thing really about mid-caps. And really it's over the long term that mid-caps grow quicker than the wider market, which is one of the reasons why they outperform the wider market.
And the fund adopts a growth-focused investment style, so you're looking for companies that are able to consistently grow their earnings year after year. So what are the characteristics are you looking for, and how does that style influence how you invest in the fund?
So we do. We try and adopt a sort of a flexible and balanced and diversified approach to investing, which means we invest really across the style spectrum, investing in sort of value, cyclicals, as well as growth. But the underlying thing really is one looking for undervaluation across the mid-cap index. If you look at some of our value names of the portfolio and where we invest, we're looking for really underappreciated assets where the growth potential or indeed the quality of that business is misunderstood and not represented in the multiple. Some of the more cyclical names, we're looking for recovery in that sort of growth outlook in terms of profitability and turnover. That's not quite captured in the current share price. And then the traditional growth names, looking for structural niche growth companies, traditional growth companies, for example, where you're not having to pay a super high multiple and take valuation risk. Looking for companies that can grow organically without, with a very sensible near-term multiple as well. So really across value sort of growth and cyclicality, really with the lens of looking for a portfolio that's built with sort of an assessment of risk, business risk, an assessment of its quality, as I mentioned before, sort of valuation as well, quite valuation discipline. So hopefully quite a broad breadth of mid-cap exposure in the portfolio.
And in recent years, we've seen lots of takeover activity among small and medium-sized companies in the UK, often by overseas-based private equity businesses at significant premiums in some cases. So why is that being the case? And do you see that continuing going forwards?
Yeah, we've just come off actually a very busy period of M&A, and traditionally mid-cap and small cap has been a pretty sort of happy hunting ground for acquirers to take over, we think, good quality companies on attractive multiples. And actually 2024 has seen quite a real step up in activity within the FTSE 250 index. Actually 75% of all transactions by value last year were in the FTSE 250 space. 11% of the index, can you believe it, got taken over last year by value. Traditionally, historically, that's about 6% to give you a sort of feel for the sort of activity. And it comes down to valuations. You've got some very good companies with a long-term track record, quality management team that are trading on very undemanding multiples, which makes it very attractive to outside capital. Actually, interestingly, this year we've seen a step up, 2024, step up actually in corporate buyers as well, and 55% of transactions have come from corporate buyers. 2023, there's more private equity, but we think with the rise in cost of debt, for example, an increase in business confidence in the outlook, actually corporate acquirers with strong balance sheets have very much come to the fore. And we've actually seen quite a few overseas deals as well. You're right on the healthy premium, 40%. That is the average for 2024, so a good premium. Not all have gone through though, because it's a bit of a double-edged sword. I mean, clearly what we don't want is some of our best of British businesses being taken over on low multiples or a price that doesn't capture that sort of future value. So we have seen a few deals that have been scuppered or gone away. It's good to see that sort of discipline from selling shareholders.
And typically an investor might expect larger, more mature companies to offer them a higher yield than perhaps mid-caps that have got lots of growth still ahead of them. But in recent times, we've seen an almost comparable yield between the mid-cap part of the market and the larger cap part of the market. So what do you put that down to? Yeah,
that's one of the things we're getting quite excited about at the moment, because there is very much an income and growth story, we think, developing for the FTSE 250 mid-cap index here in the UK. If you look at the sort of valuation of the 250 index versus the wider market, or indeed the FTSE 100, you've got valuations on almost parity with the FTSE 100. So if you look at the 12-month forward PE multiple of the FTSE 250 on about 11.5, 12 times, that's comparable to the FTSE 100. The 250 normally trades at a premium to the FTSE 100 because of that growth profile I mentioned before. It also means actually the yield, and you're right to point that out, the yield is almost at parity again with the FTSE 100, traditionally seen as an area of the market that gives you yield, sustainable yield, for example, in businesses that are growing a bit slower. Actually, because of the price decline we've seen in the FTSE 250, because companies are acting at the moment, we think pretty strong in terms of profitability, cash flow and dividend growth, you've got a yield in the FTSE 250 which is a high 3%, comparable with the FTSE 100, again a high 3% yield. So it's quite rare where you get the FTSE 250 trading at parity with the FTSE 100, given that sort of valuation compression we've seen, and of course the yield. As I mentioned, that's backed up as well by strong balance sheets, and the FTSE 250 is quite lowly levered as an index, for example. So dividend yields that are pretty solid and in fact growing, and of course overlaid with that you've got capital returns coming through special dividends, but more importantly share buybacks as well. So companies deploying that capital into a share price that is weak, a valuation that is low, so you're getting an excess return through that share buyback as well.
And reflecting on your career so far, what top investment tip have you picked up along the way that perhaps might have been useful to know at the start?
Yes, good question. I've been very lucky in my career, Joe, actually starting 25 years ago with some wonderful investors that were very experienced at the time. 3 or 4 individuals that were sort of the founding members of the Rensburg Fund Management team based out of Leeds when I joined, straight out of university primarily. So really schooled and mentored by those individuals who all had a slightly different sort of investment style, a different slant on it. So I got a good grounding across sort of blue chip, mid cap and small cap with those investors. Obviously being based in Yorkshire, very much a sort of common sense approach to investing, but really drummed into me quite early on about valuation. The price that you pay is sort of paramount for future returns, backed up by having a safety net. You make sure you look after the sort of balance sheet and be very, very well aware of the balance sheet strength, but also cash flow as well. So real valuation, almost value school into me quite early on.
And outside of work, how do you switch off?
I'm fortunate to have a wife and 2 kids that seem to take up an awful lot of my time in my free time, which is fantastic. So when I switch off, I quite like sort of going outside, getting back to nature. Quite like walks with the dog, but whisper it quietly, Joe. I quite like a bit of gardening, sort of a skill and a hobby that developed through the pandemic that I've carried on. Quite like getting the hands dirty and planting seeds and pulling up weeds, for want of a better word. So I quite like a bit of gardening, certainly when the weather's nice.
Thank you for joining us.